Suddenly, many people are seeing thousands of extra dollars disappear from their earnings this year. The Medicare Surtax, an additional 0.9% tax, is hitting more households. This specific tax applies to earnings above certain amounts. For individuals, the threshold is $200,000. Married couples filing jointly face it once their income surpasses $250,000. I mean, that is a lot of money to just disappear. This extra tax was first introduced with the Affordable Care Act back in 2013. Its aim was to fund healthcare reform. But what seemed like a tax on the wealthy then is now catching many people who would consider themselves middle class. Rising wages and inflation are pushing more income earners over these fixed thresholds. Someone earning $200,000 a year is suddenly subject to this additional tax burden. That is a substantial change for many household budgets. Let's look at the numbers closely. The standard Medicare tax for employees is 1.45% on all wages. But once your wages hit that $200,000 mark for a single filer or $250,000 for a joint filer, an extra 0.9% gets added. This means your effective Medicare tax rate jumps to 2.35% on income above the threshold. For example, if a single person makes $210,000, their first $200,000 is taxed at 1.45%. The remaining $10,000 is taxed at the higher 2.35%. That is $90 more just from that $10,000 slice. And it adds up over time. For someone making $300,000 as an individual, a full $100,000 would be subject to the higher 2.35%. This equates to an extra $900 in Medicare tax. This surtax is not just about wages. It also affects self-employment income. Self-employed individuals usually pay 2.9% Medicare tax on their net earnings. With the surtax, an additional 0.9% applies to the portion of their net earnings from self-employment above the thresholds. This brings their total Medicare tax rate to 3.8% on that higher income. Imagine running a small business and suddenly facing a larger tax bill on profits over $200,000. It is a huge shift in financial planning for many. The government collects these extra funds for Medicare trust funds. This means fewer dollars staying in the small business itself. There's another layer here, the net investment income tax, or NIIT. This is a separate 3.8% tax. It also kicks in at income thresholds, $200,000 for individuals and $250,000 for joint filers. This NIIT applies to things like interest, dividends, capital gains rental, and royalty income. It means that high earners are not only paying extra on their earned income, but also on their investment income. So if you have significant investments and a decent salary, you could be hit twice. Many people do not realize this until tax season, creating surprises. The combined weight can be quite substantial. Consider a married couple filing jointly with a combined income of $300,000. Their first $250,000 of wages is taxed at 1.45% for Medicare. The remaining $50,000 is then taxed at 2.35% for the additional Medicare surtax portion. That $50,000 incurs an extra $450 in Medicare tax alone, but then imagine they also had $75,000 in investment income. Their NIIT kicks in on the $75,000 above the $250,000 threshold. So they pay 3.8% on that $75,000 of investment income. This adds $2,850 in NIIT. All of this makes a big difference to their annual finances. The combined impact of the 0.9% additional Medicare tax and the 3.8% net investment income tax can mean a 4.7% increase on certain income types. This is a significant chunk of money for many families. It is not just the very wealthy who are feeling this pinch. An inflation rate over recent years means that income levels that felt comfortable a decade ago now barely keep pace with the cost of living. Yet the surtax thresholds have largely remained fixed since 2013. This means more and more families are falling into this higher tax bracket for Medicare. It affects how they save, how they spend, and how they plan for retirement. These fixed thresholds are the key problem. Small business owners often struggle with these extra costs. Their net earnings from self-employment can easily exceed the thresholds. They pay both halves of the Medicare tax, which is 2.9% on all net earnings. Then adding this additional 0.9% makes it harder above $200,000 or $250,000. For many small businesses, their personal income and business income are tightly linked. It means less capital for expansion or fewer funds to reinvest in their operations. This can actually slow economic growth slightly. The tax code is complex, and this surtax adds another layer of complexity. Many people do not even realize they are paying this until they see their W-2 or review their pay stubs. It is often withheld automatically by employers, but if you are self-employed or have a lot of investment income, you might be surprised at tax time by an unexpected tax bill. Financial planners consistently advise their clients to account for this surtax. Ignoring it can lead to unexpected tax bills and penalties. Estimating your income carefully throughout the year is crucial. Making estimated tax payments correctly helps avoid underpayment penalties. The purpose of the surtax was noble. It aimed to shore up Medicare funding. The Congressional Budget Office estimated it would generate over $318 billion over 10 years from 2014 to 2023. But the practical effect has been wider than intended. The middle income bracket seems to be expanding upwards, and therefore more people are swept into this additional tax obligation. When an individual earns $200,000, they often do not consider themselves wealthy. They are often paying a mortgage, raising a family, saving for college, and retirement. Every extra tax deduction makes a difference. This surtax impacts millions of Americans. It is not a trivial amount. The number of taxpayers affected has steadily grown since 2013. Each year, more people cross the thresholds. This trend is expected to continue. People need to adjust their financial strategies. It might mean adjusting investment portfolios or reevaluating retirement savings plans. The cumulative effect of this tax over years can be substantial. Imagine an extra several hundred or even thousands of dollars taken annually over 20 or 30 years. That is a significant sum of money. The threshold for this tax is not adjusted for inflation. This is a critical point. If it were adjusted annually, fewer people would fall into this surtax bracket naturally. But since it remains fixed at $200,000 for individuals and $250,000 for joint filers, more people are subject to it each year as incomes rise to keep pace with cost of living. This lack of inflation adjustment means the tax casts an ever wider net. It is a quiet but powerful mechanism for increasing government revenue over time without explicitly raising tax rates. It is a silent tax increase for a growing segment of the population. Understanding these rules is vital for anyone nearing these income levels. For example, if your income hovers $200,000, a large bonus, a sudden increase in investment returns, or even a second job could push you over the threshold. Then you are subject to the additional 0.9% on that excess income. It means careful monitoring of your financial situation. Tax planning needs to include strategies to minimize its impact. Some might consider tax-deferred investments more seriously to manage adjusted gross income. Others might structure their income differently if possible. This impacts individuals and families across various professions. Doctors, lawyers, engineers, small business owners, even high-earning skilled tradespeople, many professions can push an individual or couple into these income brackets. It is a widespread issue affecting a diverse group of taxpayers. They all share the common thread of contributing more to Medicare than they might have anticipated. The impact on disposable income is real and measurable, leading to less money for essential goods or discretionary spending. Every dollar counts for these families. The overall tax burden in the United States includes various layers. This Medicare surtax is one of those less talked about but increasingly significant layers. It often gets overshadowed by discussions about income tax rates or capital gains taxes, but for those affected, it is a direct hit to their financial well-being. It represents a substantial increase in their contribution to the Medicare system beyond the standard 1.45% or 2.9%. And for many, it feels like a silent drain on their hard-earned money, an unexpected deduction that reduces their spending power. The goal was to ensure the solvency of Medicare. The funds collected go directly into the Medicare Part A trust fund. This fund pays for hospital insurance benefits for millions of seniors and disabled individuals. So the money does serve an important purpose, but the method of collection and its widening net concerns many taxpayers and financial experts. The discussion around its impact on the middle class continues to be a point of debate among policymakers and economists. It is a complex issue with real financial consequences for millions. Paying extra taxes is never fun, but understanding why and how is important. This surtax means a small but noticeable portion of earnings goes towards a specific government program. The overall amount collected annually from this surtax is in the billions of dollars. In 2022, for example, it added an estimated $9.8 billion to Medicare revenue. That is a substantial sum, but the personal cost for those suddenly facing it for the first time can be a shock. It really makes you pause and consider your finances. This quiet tax has a loud impact.